everybody knows the advising team here with us, I'm sure. Our general disclaimer, pretty much have a quick read through that. I know everyone's just reading it right now. Pretty much says that nobody can be held liable for anything that is said or done ever. So the reason for today's webinar is on taxes. Primarily on taxes, to answer some questions about when you're filing your taxes, what you need to know, what you can expect in terms of slips, and just trying to make it easy. Usually starting around this time of year, we start to get a lot of emails, a lot of phone calls of clients wondering, have they received anything? What should they be receiving? What do they do next? And it's always very complicated. One, because we obviously know what you're supposed to get from us, but we don't know what you're supposed to get from other potential, employment, investments, all these other things that you could have going on in your life where we only have access to a certain amount of information and slips that we can provide you. So we're going to go through and kind of break it down to what you're expecting and try to simplify this because, as you know, during tax time, the government doesn't like to make it very easy on us. And that's why I always like my favorite kind of meme jokes of the government going, you owe us money, it's called taxes. And we always respond by, that's fine, I understand, I'm here for the people, I want to help out, do my part, how much do I owe? Well, you have to figure that out. So I just pay whatever I want? No, the government, they know exactly what you have to pay, but they want you to guess that number too, because in case you get it wrong, then you go to jail or get a fine. Or you get all these calls from CRA saying, you owe us money, please send it to Nigeria and we'll promise to pay off your debts. All these kinds of fraud. So lots going on around tax time. And we want to make sure that you're as well informed as you can. So what we're going to go through today is what you can expect from this tax season in terms of slips, where to find them, where to access them, and what to do with them after that. And then we're going to go through some additional tax saving strategies. So going through the RRSPs, income splitting, TFSAs, eligible Canadian dividends, a lot of the stuff that we're doing for you, or maybe you want to have a second look at what you could be doing to improve your situation. And then we also just kind of snuck in here a quick market update from Elvis, just based on everything that's going on in the world. We thought it would be helpful to give a little insight there as well. So let's jump into it, what to expect this tax season. So tax slips, what can I expect? So if you made an RRSP contribution, you get a contribution slip to file with your taxes that reduces your income, that provides tax savings or a refund. So these slips are sent out, and the latest they are sent out is March 1st. So you should be receiving them, by the middle of the month, by March 15th, no later than near the end of the month. If you haven't received it by then you want to kind of look into that or contact us. The same thing as if you're taking money out of your RIF or out of your RRSP, you also get generated a slip, similar to a T4 slip, because it's income. It's money that you're earned or money that you're paid, where you have to pay taxes on that. So those also get mailed out the latest by March 1st as well. TFSA, we get a lot of questions about this. I put money into my TFSA, I took money out of my TFSA, I don't have a slip. Did I make money in my TFSA? I don't have a slip. You never get any slips for your TFSAs in terms of contributions or withdrawals. That's the whole point of a TFSA. It's tax-free. You don't have to worry. You don't have to worry about that. Now, this is where it gets more complicated, are the non-registered accounts and all the different slips. So for clients that have been dealing with this for many years, you might be used to it, getting all these slips, but for, clients that are new to investing in non-registered accounts, that maybe 2021 was their first year, you're going to get a lot more slips than you're used to, and they're for a lot of different reasons. So from a non-registered account, the slips that you can expect to get are all these different T slips. So you're going to get a T5 slip, a T5008 slip, and a T3. The T5s and T5008s, most of those come from us, where we have access to them, whereas the T3s come from the mutual fund companies or their trust income, and those are sent to you directly from the investment company, where we do not have access to those and we do not send those. And I'm going to go into more detail about these, but just kind of off the bat, what you can expect. Additionally, these are not official tax slips. These are not T slips or T4s or anything like that, but these help you when you're doing your taxes and will help your accountant. So we also send you a realized gain loss report, which itemizes if you bought and sold anything for a gain or a loss. It'll tell you your profits, what you paid for it, what you sold it for, and what you made or lost on that to report on your taxes. It'll break it down. The foreign property report will be sent to you as well, which outlines all your foreign investments. Now, a lot of clients, we get questions going, well, I thought I had investments in the US and globally and all that. Well, you do, but they still may be invested through a Canadian, say, trust or mutual fund, which is domiciled in Canada. So although you have access to Amazon and Apple and all these US and global investments, it's still based out of Canada, so it will not show up on that foreign property report. The annual fee letter just outlines all the investment management fees that you would have paid throughout the year, and you can deduct these fees off your tax return. So that'll give you a summary of your annual fees that are tax deductible as well for your non-registered account. The investment summary, the investment income summary, and trading summary. Again, these are just providing more details and background information that is attached to your T5s and T3s for where all and T5s where all that income or those capital gains came from. More specifics, because the T5 income, for example, the T slip will show you the total amount. But if you want to see a summary or of every individual dividend that you received from all the individual investments, that's where this will give you all that information and outline all that all those details for you. So it's additional kind of information that your accountant may want to see, or you may want to see or kind of dig through, but it's not necessary to file your return. So the biggest thing we always like to hammer home is not to file your return too early. Do not file it before April 15th, because as I showed you, the mailing dates here on the side for the T-slips can be mailed as late as March 31st. Most of them should be sent earlier, and I would expect to receive most of your slips in the middle of March. They're starting to go out in the next, around now or in the next week, get mailed out, but they can wait to mail them until the end of March, which means if you're waiting on the mail or in Canada Post, you aren't going to receive those until, mid-April at the earliest. So what I would recommend is get everything in order. You can even give it to your accountant. They can prep everything, but do not hit the button. Do not file until the end of April. Because if a T-slip comes in after you filed, then you have to go and amend your return, and it's just a hassle and more work, and it complicates things for everybody. So I know that you're eager and you want to get these taxes over with, and you want to maybe get your refund as soon as possible, but we always recommend holding off until after April 15th to file your return. Like I said, get it all ready to go, but just hold off so you can continue to give your accountant information. With that, I also wanted to just do a poll just out of interest here and see, who is currently doing your taxes? How many people are doing them themselves with filing through a program, online, or who is actually using an accountant to file their taxes? So I'm just going to put this up here. Apologies about that one. It's actually taking a second to get up there. Okay. So how do you file your taxes? Are you using an accountant or are you filing them yourself? Now, if your taxes are straightforward.
Sorry, Aaron, just to jump in quick, just so if nobody is aware, on that same column, Aaron is doing a poll. Under the chat function, there is a little icon called poll.
It should just pop up into their screen as well.
Oh, okay. Yeah. Okay. Sorry. I shall disappear again.
No worries. Yeah, so if your taxes are relatively simple and you just have your T4 and an RRSP slip and they're straightforward, the programs, to be honest, they can handle a lot of that. When you get into your non-registered investments and your situation gets more complicated, rental properties, you have deductions, everything else, and if you're not confident around your, tax filing skills, then you may want to, use an accountant to double check. I use an accountant because I want to have everything filed. I want to give all that information. I want it all double checked. I want it all coming from the accountant. And so that's the way I go, even though I have a good understanding and I can obviously do it myself. So we're at about 50-50. So hopefully the ones that are doing it themselves are kind of more on the simpler side, and the more complicated non-registered side, you're using a professional. Okay. So just an example of what a T-slip, in case you've never seen one, this would be a T5, for example. There's all the different boxes that come in, and they'll be obviously have the information, the numbers will be printed in there for you then to file, or they'll be plugged into the appropriate boxes when you do your return. Just a quick snapshot there. Okay, so we've gone over what you can expect to receive. Now, where can you get the slips? So the first place I would go to look, or one of the places you go to look, is my online portal. If you haven't registered yet for the online portal, we just recently sent out an email to everybody that gives all of this tax information we're going over today, as well as how to register for the portal, the links to the portal, more kind of documents about the portal and how to use it. So there's all kinds of information there. So check your inbox, check your junk mail, wherever it might be. That just recently went out. And I would strongly encourage you to register for that, not only for your access to your tax documents, but you can get all your statements and the other documents there. You can check on your portfolio performance, what you're invested in. You can get the balances. You can get all your information there. It's a really useful tool, especially in today's environment. Similar to that, my CRA account. Has anyone tried to call CRA? I don't even have to do a poll to see if you had a good time or not, because nobody has a good time trying to contact CRA. You're going to be on hold forever. So again, we strongly encourage you to set up an online My CRA account, because that will have all your tax information. When you're filing your taxes, as I said before, CRA knows how much you owe and what you should be paying. They have all that information. So when you go with My CRA account, when you log on, all your T-slips, everything is going to be there that you need. So having that portal there to log in and get all that information all in one place is extremely useful, at least once a year, as well as it'll tell you your RRSP room, it'll tell you your TFSA room. It's a great service rather than trying to call them and get in touch, where you will be on hold for 3 to 5 hours trying to get through. And then when you get through, they'll hang up on you by accident, or they can't help you, or they'll have to call you back and you'll go through it all again. So if you want to have a terrible day, call CRA. You will not like it. So we will also mail them out. You can get them in the mail. But again, we're not in control of Canada Post. I don't know how long that's going to take to get to you. I don't know if it will get to you. We send them in the mail, but we want to ensure that you have all your slips. When clients ask me, do I have everything? I don't know what you have unless you laid it all out in front of a desk on me and we cross-reference. I don't know. I know what we sent you. I can tell you what to expect, but I don't know what you have. But they will get sent in the mail if that's how you're expecting it. So registering online, getting these two portals set up, the CRA and my online portal through us, is definitely something we strongly recommend doing. The other thing to note is if you're on our portal, but you're on our older version called My Portfolio Plus, that is not going to have all the information you need, and it is starting to close down. It's our old version. We've updated and we have the new version, which is much better. So we encourage you to migrate over there. If you go through My Portfolio Plus, it should prompt you, as well as just going to our general website where you log into the new portal. You want to just go through those steps and just set up the new portal anyways, because it has a lot more information and it's going to be a lot more useful going forward. So this is what our website looks like for when you go to log on to the client portal. So pretty straightforward. We log in, you put in your information, you can get started and register. It's got all the information you need there. It's really straightforward. And if you do need any help, we're always here to help you, but it'll walk you through the steps, as well as that email that we did send out to you as well. Once you're in the portal, this is what it looks like. And this is all the information you need to know to get all your tax slips that are coming from us. So on the left here, we've got your documents highlighted. So you go down, you click your documents, and then you want to go through the different filters to get rid of all your monthly statements and the stuff you don't need. So in terms of period, the time period, just if you select current year, And then you select your tax slips and the year-end reporting. That'll give you all the slips you need here. You can select them all and generate a document to, create a PDF that then you can use to cross-reference, give your accountant whatever it is that you need. But all those documents will be listed here. Similarly, on CRA, you log into your account, pretty straightforward. You select your tax information slips, T4s or more. And then when you go here, you select your year, 2021, all slips. Next, boom. You've got all your tax slips you need here. You can open a PDF and it'll generate all your slips, including your your T4, which we're not sending you. It'll give you your T3s, which we aren't sending you. The mutual fund companies are sending you, as well as TFSA contribution. All your information is available on the CRA website. So again, strongly recommend going through that portal. So a lot of this will be repetitive, but I'm repeating it because I want everybody to completely understand where everything's coming from and what you can expect. So how will I receive my documents? Mail. So your mutual fund, if you own mutual funds in a non-registered account, those T-slips will be mailed to you. We do not have access to these slips. We do not send them to you. They come directly from the investment company. They will be on your CRA website, so you can get them off there as well. Those are the two places for your mutual fund T-slips. All other tax documents from us will be mailed to you, as well as be available online through through our portal, your online portal. Unless, this is the big kind of thing to note. If you have selected to receive all of your documents paperless, that would have been done by you manually going through and checking that box to receive all your documents, your tax documents paperless, then they will not be mailed to you. They will still be available online through your online portal, but they will not be mailed to you. So if you're sitting there waiting for things to come in the mail and you haven't received anything from us, or you're missing something, then check the online portal. You probably selected to receive them digitally. Again, the reason to be registered, everything is online. So for the online portal, everything that we send you will be on there. On the CRA website will be everything that, all the T-slips, including the mutual fund T-slips that we don't send you. So the only thing on the CRA website to note that you will not have access to that we do send you and is available on our portal is the capital gain loss report, the fee report, and the foreign property report, because those are not official tax T-slips. Those are reports that we generate to help you in filing your return to give you more information. Those are not available on the CRA website, but they're available on the portal. Again, I know this is a lot. We're throwing a lot of information, trying to remember what's what. So I repeat it and I give you this summary. We will send you all your T-slips for your stocks and ETFs. We will send you your gain loss report, your fee report, and your foreign property report. So we'll send them to you and they're available online. The mutual fund company will mail you your T-slips because you don't have an online portal with them. They'll mail you your T-slips. So the online portal, everything that we send you is available there, but CRA has all your official tax slips, the T-slips, from the mutual fund company and from us. So the recommendations of how to do your return, let's keep it really simple. And this is how I do my return. Have your accountant or your tax program import all of your tax slips from CRA. So that'll be all those T-slips that you need. Provide your accountant with your gain loss report that we sent you, are available on the portal, the investment fee report, again on the portal we sent you, or the foreign property report that, again, we sent you or on the portal. And then once you've given all that and you've done your return, or the accountant's done your return, review and cross-reference everything that you were expecting to receive, that was input into your tax return, and that makes sense. You want to check it over. You want to make sure it makes sense. I've had a couple calls from clients, or 6 months later a review where they're mentioning, my tax bill was a lot higher than I thought it was going to be. I owed 10 grand. I didn't think it was going to be like that. I'm like, well, wait a minute. Show me your return. Let's see what happened. And then we dig into it and I can find a mistake. Their accountants are professionals that did this, but they missed the box. They inputted it wrong. And when it was submitted, they didn't catch that. They missed the cost base and they just had some proceeds. So they didn't have a deduction there. So an example, you want to check your work. When I go to Costco and we fill up the cart and it's packed full, you can barely see inside it. I've got 2 kids riding up in the cart with me and you push it through the exit. They've got that checker there. They grab your receipt that's like a mile long and they don't just put a line down. They actually look at every item to make sure you're not taking anything, right? Like they're very diligent. So they're checking everything. We should check our tax bill. When I take the family out for dinner and I get the bill at the end of the night, I open it up and I go through it line item by line item to make sure it all makes sense and the bill is correct. Put the credit card in and go pay for it. So if you're willing to check all these bills and Costco is willing to diligently check your cart, I think we should look over our tax return as well, just to make sure it makes sense. And the one thing we want to make sure that we're doing is deducting our management fees and not filing too early. Those are the 2 kind of end tips that we'll leave it on. So with that, we'll bring in John and he'll give you some more information on some better ways to hopefully plan for the future and keep saving tax.
Absolutely, because as our dear friend Albert Einstein here just said, hardest thing in the world to understand is income tax. And that's saying something because if memory serves me correct, he was a kind of a bright guy. So I like this philosopher a little better. And if you want to tell your kids, have a teachable moment with them, you want to tell them about taxes and how taxes work in Canada, well, eat 30% of their ice cream, see how they feel about that. So before we talk about, Aaron, that's some great advice you just gave everybody, advice or tips, just ways to find your tax slips. This is obviously, I think they call this tax season, they call it tax pain. It's always a pain in the backside because there's so many spinning plates, lots of things to track down, deadlines, all sorts of stuff. So hopefully that first part of today's presentation really kind of clarified where to find some of those documents you might need. For the latter half of the presentation, we're just going to go over a few different tax saving strategies that you might want to consider for 2022 and moving forward. And before we do that, what we want to do is kind of talk about the tax system in Canada first. Now, most people understand, obviously, how it works in Canada, but just to make sure that we all have the same level of understanding, in Canada, we have what's called the marginal tax bracket system, which means not every dollar is taxed the same. So in other words, I'm going to turn on a whiteboard here. No, I'm not, because that didn't work very well. I thought I could highlight things here for you. I'm just going to direct your attention to the screen here. If you look almost right in the middle of the page here under where it says 2022 top marginal tax rates. If you look down the other income aisle and you see 20%, 22.7%, and 28.2%, these are the marginal tax bracket increments that your dollars get taxed at. So in other words, if you start earning $1, every dollar you earn pushes you up this tax bracket. It moves you up a little bit higher. And in other words, if you made, say, $130,000, you are in a 40% tax bracket, but not all of your dollars were taxed at 40%. Just the next dollar is getting taxed at 40%. And any dollar between, say, $120,000 and $130,000, that is also getting taxed at 40%. Any dollars below that are getting taxed in lower tax brackets. So as you can see, every time you add income to this pile, you are pushing yourself effectively into higher and higher marginal tax brackets. And what kind of income gets included in this? While you're working, it's employment income. When you're retired, it's pension income, it's CPP income, it's old age security benefits. If you have a rental property, it's rental income. All of this kind of stuff, if you have income coming from any combination of these sources, they all get added together and pushed into a pile, which again moves you up those tax brackets. So in other words, if you make a lot of money in Canada, you pay a lot of taxes in Canada. So we want to show you some strategies as how do we turn the clock back on that? How do we say, I don't want to move up the ladder? How do I move down the ladder? How do I get into those lower tax brackets again? And the other thing we're going to talk about, and I'm not going to do it right out of the gate, but we will talk about these eligible Canadian dividend tax rates as well. Because as you can see under other income, there are quite a few, or there is quite a bit of tax payable on all that sourced income. But if you skip 2 columns over to the right, column called eligible Canadian dividends, these are the tax rates for dividend income. And we'll let Aaron come back in at the end and kind of tell you a little bit more about that as well. But I'm going to start with some RSPs. That'll be the first thing we talk about. We will talk about those eligible Canadian dividends, and we'll talk a little bit about income splitting. But I want to start with RSPs because increasingly they're getting kind of a bad name. People don't generally like RSPs, and I'm here to defend their honor, tell you they actually are pretty cool. Hopefully they'll start getting invited back to parties sooner than later. What is an RSP in the first place? Really, it's just a personal retirement portfolio, much like a personal pension plan, similar to a defined benefit plan, except for you are in control of it. But what it does allow you to do is, again, every time you earn more income, you get put, just to keep reiterating that point, if you take $1 and you throw it into your RSP, you can start going back down the ladder. Every dollar you put in RSP gets deducted from your income, and you start climbing down the ladder. So that is one way to report, saying, I'm making too much money. How do I not pay tax on all of this money right now? You put the dollar into the RSP, the dollar is deducted from your income. And if you are, say, a salaried employee that gets all of your taxes deducted at the source, so that if you didn't use the RSP at the end of the year, you don't owe taxes, but you're not getting anything back. If that individual throws $1 into the RSP, you are getting a tax refund as well, because you've used an after-tax dollar to put it in the RSP. The government says, well, you shouldn't have paid tax on that dollar, and you did. How much tax did you pay? That's what their marginal tax bracket will tell you, and that's the size of the refund. That percentage of refund is generally what you're getting back. So why would we even use the RSP? It sounds pretty nice, right? As it does allow us to move down that tax bracket ladder. But everyone knows, and the reason that they don't like RSPs is because you have to pay tax when you take the dollar out down the road. The simple math says, if you can put $1 in a high tax bracket, take the dollar out in a low tax bracket, you will win. So let's use an example. Somebody makes $130,000 a year. They're in a 40% tax bracket. They throw the dollar into the RSP, they get 40 cents back. In retirement, they take the same dollar out, but then they're only earning $60,000 in pension income. They're in a 28% tax bracket. Dollar comes out, the government says you owe us 28 cents. That person says that is okay because you gave me 40 cents back in the first place, and I deferred all of the income tax while the dollar was left in the RSP, and now when I take it out, all you want is 28% back. Go for it. That is still a win for you, the individual, and that's why RSPs make sense. If you want to use the RSP program, though, if you want to take advantage of moving down the marginal tax bracket ladder, just know when $1 goes into an RSP, it is effectively spoken for retirement income. Because what is an RSP? It's a personal pension plan. So this dollar that goes in is effectively spoken for to help generate additional retirement income for you. Don't put the money in the RSP if you're going to take it out and buy a boat with it in a week or a year or 5 years for that matter. Put it in to give you more supplemental income in retirement. You are allowed to defer the income tax and the income on every dollar in that RSP until you turn 71. At that point, you're going to be required to turn your RSP into a registered retirement income fund, more commonly known as a RIF. So if you hear us throwing that term around, RIF, that's what we're talking about. All RSPs need to be converted no later than the year in which you turn 71 into a RIF. When you turn 72, that following year, that's when you're required to start taking the money out of the account. Now, you can do this anytime before 71, but that's the latest they'll let you defer the income. Because after all, there are potholes to fill, and the government does need tax revenue, so they will eventually make you take some money out of your RSPs. So how much can you put in your RSP? Well, your average Canadian, if they're not a member of a defined benefit pension plan or another pension plan, they can put in 18% of their income up to a maximum of $29,210, plus any sort of carry forward room. So in other words, in order to generate RSP contribution room, you have to earn more income. And in some years, you might decide, well, I didn't want to make an RSP contribution this year. That contribution room that you did not use, you did not lose. It just carries forward into next year, and it's like a snowball. It just keeps accumulating and growing. So this $29,210 maximum that we're showing on this slide applies to somebody whose 18% of their salary equals that, and assuming they have no room that they've carried forward. If somebody has carried forward $50,000 worth of room, and they have another $29,000 max this year, in reality, they have $79,000 worth of RSP room that they can use at any time. But why would we say don't use an RSP? We would say don't use an RSP if you are earning, say, under $50,000 and you're in a 20 or a 22% tax bracket. And that's because when you get to retirement, you're likely going to be in a 20 or a 22% tax bracket. And that's when my frugal brain starts switching off saying, well, that math doesn't work anymore. If you're going to give me 22 cents back now, and you're just going to take the same 22 cents back down the road, now I might even agree with you. What is the point? So really, just know you don't have to use your RSP room in any given year if the math doesn't work. But if there is a year where you're in a really high tax bracket, I would suggest using the RSP. Absolutely use the RSP, as long as it's for retirement. So here are some strategies. Again, it's for long-term retirement income, not for lump sum withdrawals. If you are earning over $50,000, you're effectively in a 28% tax bracket. So you can start thinking about putting money into the RSP at that point. Though again, always best to maybe just number crunch, make sure that you're not going to end up in a 28% tax bracket in retirement. You might be thinking, this is great, John. RSP deadline was a week ago. And thank you for bringing this up now. I bring it up now for the third point here. A lot of people generally tend to scramble at the last minute in the first 60 days of every year, right up until that RSP deadline, trying to get some money in last minute, make sure they get those deductions. If you can do this on a monthly basis, you're really going to save yourself some stress getting down to the deadline. It's the wealthy barber model where you're going to be paying yourself first, right? If anybody hasn't read that book, you don't have to worry about it. That is effectively the whole moral of that story, right? Pay yourself first. Treat your RSP savings like a non-negotiable expense, like a mortgage or a car loan or something like that. So again, paycheck comes in, dollar goes out to the RSP. You've effectively saved for your goal. It just takes some of the stress off your plate trying to come up with the money at the end of the day. Now, if you said, hey, John, I like the idea of saving for retirement, but I kind of also want to pay off my mortgage before retirement. I'm still, as long as the RSP makes sense for you in the first place, I'm still going to probably suggest that you use the RSP first. Just think about this conceptually. Somebody who is in a 40% marginal tax bracket and has a mortgage with an interest rate of 2% says, I have $1. Which one should I allocate it to? I want to retire. I want to save for retirement, but I also want to pay off that mortgage. Well, if the dollar goes in the RSP first, you're saving 40 cents. You're saving 40% in tax. You are going to get a tax refund. The tax refund that comes back, that can now be applied to the mortgage where you're saving 2%. So this is a way where, again, an RSP, getting a bad name might actually be a pretty helpful tool to let you save for retirement and pay off debt. Because if you don't have a mortgage, you can also apply the same strategy to credit card debt or car financing debt or something like that. You also, again, if you know, let's say you have a rental property and it's accumulated quite a bit in value, and you know you're going to sell it, say, closer to retirement, you may be on the hook for quite a large capital gain, which is half of that which is taxable. What you might want to do to offset that capital gain is hold on to some of your RSP room if you know that this looming capital gain is coming. In the year in which you sell your property and trigger the capital gain, you can take a large chunk or as much of the proceeds from the sale of that property as you want or are permitted to put in your RSP and put it in your RSP to help offset that gain, the taxable portion. So a lot of cool things you can do with an RSP. I know they get a bad name, but they are pretty cool. I already talked about the mortgage one. I won't bore you with that again. Another cool little feature with the RSP is that you can income split from it. And a lot of people know about income splitting from pensions and stuff like that. And we'll talk about that in a second. But your RSP income, your RIF income, that can be split as well, as long as you're 65 or older. And you said, well, what if I retire early? How do I income split with my RSP? You can use what's called a spousal RSP. So here's an example. If anyone's not familiar with it, we're going to roll through an example. We got Mary and John. Mary earns $100,000. In this case, she's in the 38% tax bracket, and she's a member of a defined benefit pension plan. John stays at home, or I guess works occasionally. He makes $10,000, pays no tax, not a part of a pension. At this point, I'm not really sure what Mary sees in John, but he must be a lovely individual. In this case, Mary earns all the money. So if someone's going to make an RSP contribution, it sure makes sense that it would be Mary. Mary's also going to retire with the pension. So we don't want her taking all the pension income too, because she'll have the RSP, she'll have the pension. Yes, the pension income can be split, but she'll have to wait on that RSP to split that with John, her spouse. So what she can do instead is say, I'm going to open a spousal RSP for John. I'm in the higher tax bracket, so I will put $1 in the spousal RSP for John. Therefore, I need the room. I will get the deduction and I will get the refund. John gets the money. So if you're going to use a spousal RSP, the first thing you need to do is love your spouse. In this example, if Mary and John want to retire early, well, Mary can always income split her pension. And if she and John both have money in their RRSPs, well, they don't have to worry about splitting Mary's RRSP. John can take the money from the spousal RRSP. And Mary can take a little bit from her RRSP. And it's just another tool for you to effectively income split before the age of 65 when it comes to your registered assets. The one thing you need to know about the spousal RSP, though, in that example, it's a last dollar in, first dollar out sort of scenario. Whereas if I contribute $1 today to a spousal RSP, my wife will have to wait 3 years before she takes that dollar out for that dollar to be taxed in her name. If she turns around tomorrow and takes the dollar out, it's still taxable in my name. So always give yourself a 3-year buffer between the last dollar going into a spousal RSP and the first withdrawal that gets made from it. Income splitting. As we said, you can do this with the RSP RIFs at 65. That can be split evenly among spouses. The other thing you can do, if anybody is a member of a defined benefit pension plan, you can income split that, you can split that income with your spouse up to 50%. And it's nothing you would have to do with your pension provider. It's something that you do when you file your income taxes every year. So it can be a year-by-year decision. You don't have to make the decision and do it every single year. You may just find it advantageous to do it in some years and maybe not in others. But at the end of the day, this is another tool for you to say, hey, if I have rental income and pension income and RSP income and CPP and OAS, if it's all coming to one spouse and not the other, income split it so that you both keep your overall tax or your overall income levels at a lower tax bracket and away from that old age security clawback threshold. So if you make too much money, roughly $80,000 or more in retirement per individual, they will start clawing back some of your old age security benefit at 65. So this is another strategy that will allow spouses to keep their incomes at a lower level, just so that I'm assuming the dollar shows up in the same bank account, same joint bank account. I could be wrong. But on the way, let's just try to make sure that we pay as little taxes as possible while still keeping our nose clean with the CRA. So those are just a couple tips I'd like to kind of start the strategy session start it with. And I will turn it back to Aaron now because he always likes to talk about tax-free savings accounts. He gets the fun accounts, the ones that always get invited to parties.
I do like TFSAs. And I'm not going to spend a lot of time going through how they work. But if you're looking to save tax over a long period of time and to have tax-free income, tax-free withdrawals, TFSAs are the best way to go. They're not going to provide you any tax savings up front, like an RSP, where you get that deduction off your income. But later on in life, when this account grows tax-free for life, when you withdraw the money, there's no tax on withdrawals, there's no tax on income, there's no tax on growth in there, so it's completely tax-free. Whereas, the other only really tax-free investment we have is your principal residence exemption that can grow and sell, and you don't pay any tax on that. So we definitely want to use those, and those are a great way to, both of them. And the TFSA is a great way to invest, where you can hold any investments inside, similar to your RSP. That can grow for a long time. And in order for it to really work, you need to hold it, give it time to grow and compound and, accumulate to really take advantage of any tax savings over the long run. I just saw in the chat that there were a couple questions about those TFSA slips. There are no TFSA slips on the CRA website where I showed you. That's just your record of contribution. So you can go in there to check your room, your contributions, your withdrawals. They have a record of all that. Just remember and note that they are usually quite behind on your TFSA. So if you were to check your TFSA room today and you made a contribution in January, there's going to be no record of that. They will typically get it updated to the end of the year. So December 31st, 2021. That'll be fully updated around now or in the near future, but nothing since then for sure until next year. So they're usually about a year behind. So the other way we want to talk about it being taxed is through your non-registered investments. So I told you what you can expect in terms of slips and what you're going to get, how it's going to come out to you and report it and how you're going to file, but just a bit of a better understanding of how you're actually taxed and how much you will actually pay in tax in these accounts. So you can be taxed in 3 ways in your non-registered account: as interest, which is taxed, you have to pay that bill annually. You get it from your high interest savings, your GICs, your bonds, stuff like that in your non-registered account. It's just added on to other income. It'd be taxed the same as if you were working, had a job or a side job, part-time job, or rental income. If you want a rental property, it's taxed the same way as other income, and those are taxed at the highest rates. The next way you could be taxed is a capital gain. So you buy something for $1, you sell it for $2, you made $1. That dollar is the gain. You'd be taxed on that. And then the last way is your dividends. So you get a dividend tax credit, it grows it up, and you pay tax based on your marginal tax bracket on that end. So we'll dig into that a little bit more. And what we really want to focus on when you're looking at your non-registered account is the net, right? It's all about after-tax dollars. When people talk about I made 100 grand this year, it's like, well, how much did you get to keep? Well, I made $5,000 on this investment. Yeah, well, how much did you get to keep? We always focus on the net. So as mentioned, the interest and rental income is taxed at the highest possible rate. So it just gets added onto your income as taxed as income. So if you make $100,000 a year and then you make $10,000 from a GIC or $10,000 from rental income, you made $110,000 a year. That's all the government looks at and cares about is total income. Versus the capital gains, as I mentioned, when you make $1, you buy something for $1, you sell it for $2, that dollar gain, only half of that is taxable. So 50 cents gets added onto your income. So if your income was, $100,000, use the same example, and your capital gains was 10 grand, 5 grand gets added onto your income. So your taxable income is $105,000. And then the dividends, as mentioned, it's a more complicated calculation because you get a dividend tax credit and it grows you up, but it'll just show what you actually pay in taxes. I'll try the whiteboard as well and see if it works. And nope, for some reason, this whiteboard is not going to work today. So we will just run through it and just kind of tell you. So when we're looking at the rates, you can see how much you pay in other income. That includes your interests and your GICs and all that, which is the highest rate. So in the table, whereas you're looking between 50 and 86,000, you're paying about 28% in tax. Now, if you were a capital gain, because it's half of it is added on your tax, it makes sense that only you're paying half the rate that you would normally pay on other income. So from 28%, you go down to 14%. You're half the tax rate, which is obviously much, much better. And then the third way, when we're looking at the eligible Canadian dividends, as John mentioned, which is the column, the second furthest on the right, you can see that the tax rate for that example is only 1.63%. So way, way less than the 28% and still way less than the 14%. And if you look even below that, if your income is below $50,000, you're paying a negative 6%, and below $43,000, you're paying negative 9%. People go, well, how can you pay negative tax? Well, you pay no tax on that, and it actually generates a tax credit that you would pay less tax on all your other income. So effectively, you could pay very little or no tax on your total income. You get a refund, similar to putting in the RRSP. You get a dividend tax credit, would generate a refund or a tax deduction. So by far, the eligible Canadian dividends is the most tax-efficient way to invest, especially at a lower income, in a non-registered account. Now, we are doing this for you already. If you have a non-registered investment account for us, we do all the tax planning and the investment planning to build it in the most efficient way for you. We just wanted to shed some light on, how it works and why we're doing it and how we do it this way. So we take all of the investments into consideration and how they're going to be taxed, and then we decide where we hold them and how much we hold and what we're trying to do with that. But as you can see, the most tax efficient way when we're talking about tax savings is we want to generate some eligible Canadian dividends in your non-registered account. So we really focus on that for you, and where we get these from the Canadian banks or the Loblaws or the real estate, the REITs, amongst all of a bunch of other investments that we hold in those non-registered accounts to produce those eligible Canadian dividends. So just to give an example, we got a 6-year-old making 36 grand a year, $200,000 investment outside your RRSP, so in a non-registered account, you're in a 22.5% tax rate. If you were to make 2% on that GIC, which is, obviously a really low rate, but that's kind of what they are, low rate. You make $4,000 in tax, you pay about, or $4,000 in income, you would pay about $900 in tax. That's even at a low tax bracket. So 31 $100 would be your net return. If you were to compare that to investing in Canadian companies, good Canadian companies at a 2% dividend, which is even lower than what you would expect on average across the index, you would get about you would make the same $4,000 and about a negative $300 tax bill on that. So your after-tax income would be about $4,300 on that investment. So a 39% increase in your net return. So it's quite substantial. So when you look at that across another example in a bigger picture, and you're comparing, well, do I have rental income? Do I have dividend income? What's more efficient, and how am I getting further ahead? Well, you have $1 million in the top 60 companies, the biggest, best companies in Canada, TSX top 60. You paid $671,000 for that in January of 2001, and now it's worth $1 million. It's gone up, and you're currently receiving about $28,000 in dividends, a yield of about 2.8%. You have no other income. You pay $0 in tax. Now let's compare that to the rental property option. So you paid the same amount for the house, but it's worth more. It's done better. It's gone up more. It's worth $1.2 million. You're renting it out for $2,500 a month, so $30,000 a year. So a little bit more income than the $28,000 in dividends. You're doing this to avoid the empty homes tax. Now you're getting about $9,000. You pay about $9,000 in tax on that. So versus paying zero tax. So when you take the tax off and you look at your next return, your net return on investment that we like to focus on, and maybe you have to deduct some, home repairs, property taxes, other things, insurances and things like that. You look at, what am I really getting out of this after tax, after expense dollars? What's the return on that? Now, I'm not sitting here trying to tell people you shouldn't have rental properties or it's a bad investment or you should sell them. I'm saying is what you want to look at is, how much am I paying in tax on that? And is there a better way that I can structure my total return to maximize my net dollars? So if I have a rental property and it's completely paid off, and that's great, but if I had a mortgage on that or some debt, some more deductions, I could lower that income. And if I use that equity from the house to produce Canadian eligible dividends, that then give me a tax credit and help further reduce the income or the tax bill on that, it might make me further ahead and more diversified. So this is just an example to kind of open some ideas and try to look more broadly at what you can be doing to control your tax bill and increase your net return. And like I said, if you're checking your Costco receipt, if they're checking your Costco receipt and you're checking your $100 dinner bill, you probably want to check your tax return as well. So with that being said, I want to pass it over to Elvis, who will give us a quick market overview.
Thanks everyone for joining us. This presentation was sent out to you yesterday. It's also posted on our website. And if you have any questions, please at any time feel free to send them to us. The report that this is part of talks about the review for 2021. That's in the past. It's over and done with. So I'm going to focus primarily on the outlook for the rest of this year. The biggest development since our last webinar a month ago has been the Russian invasion of Ukraine on February 24th, which today entered its third week. And I kind of think this is the proverbial storm after the calm of 2021. 2021 was a fantastic year. Everything was smooth sailing. That hasn't been the case so far in 2022. Now, the Russian invasion, it's a development that will have ramifications that, like 9/11, will ripple out across the world for many years to come. Short term, what it means is energy and commodity price spikes. But long term, it fundamentally reshapes the global map of geopolitical risk. And in simple terms, what this means is that the world just became a more dangerous place. The weird thing, as the top table shows you, is that financial markets usually rebound quite quickly from the initial shock of a war or terrorism event. 3/4 of the time, the S&P 500 has been up about 4% just 3 months after an event. And such an event can spark a sell-off of as much as 20% or sometimes even more, which is what happened after 9/11, But back then, the US was in the throes of a recession, and the market, I think it plunged about 23%. But the point is that the shock from these events is short-lived, and the markets come to grips with the situation pretty quickly. We saw evidence of this on February 24th, the day of the Russian invasion, when markets actually closed higher after being down as much as 3% at one point. So really unusual behavior, and what accounts for this? What are the reasons for it? One thing is there's a very strong belief in the market among investors that dips like these are buying opportunities, and we share that view. The second thing is technology stocks were very heavily oversold by Feb 24th. So of course people rushed in to buy those because they fell quite a bit on Feb 24th and then bounced right back. But most importantly, what the invasion did was it injected a big chunk of uncertainty into the economic outlook. And investors took this to mean that US interest rates may not climb as much as expected. Now, bear in mind that prior to the invasion, the biggest risk factor that was of concern to investors was how high and how fast the US would raise interest rates. But the invasion, because of the uncertainty that it injects into the outlook, let's kind of put that a little bit on the back burner. If you look at the next slide, what the Russian invasion also did is it caused two pretty reliable recession indicators to appear on the horizon. Now, this is something that a lot of people are watching, but I'm not saying there's going to be a recession this year or next. It's just something that bears watching. So these two indicators are a big spike in crude oil prices and an inversion of the US yield curve, which is what happens when short-term yields rise above long-term ones. And that yield curve differential is shown on the bottom chart, which maps the difference between 2-year US Treasuries and 10-year US Treasuries. The spread has narrowed from about 150 basis points a year ago to about 24 basis points now. So it's really come down a lot. And a lot of people are watching this. The other thing is that inflation is also getting entrenched. Not just because of the commodity price spike, but also because of global supply chain disruptions caused by the war. Russia and Ukraine are huge exporters of grains, metals, materials used in semiconductor chips. So inflation naturally looks like it's getting entrenched in the financial and economic system. But on the plus side, we've seen COVID risks recede. The fourth wave is tapering off, thank goodness. And if you were to look at be a little more optimistic, the risk factors that I just spoke about could be mitigated if things settle down. For instance, if there's some sort of negotiated settlement between Ukraine and Russia, and if that happens, we could see a pretty big retreat in crude oil and commodity prices. So just look at this week as an example. At one point, WTI crude spiked to over $125. And yesterday it was down about 12%. It's down again today. So this gives us some kind of hope that, perhaps things will settle down and crude oil prices will back down, and so will commodity prices. Also, on the positive side, the earnings outlook looks really solid, with earnings for the TSX and the S&P expected to rise about 10% this year and 10% next year. And why is this happening? It's because the labor market is so strong and people, are pretty flush with cash from all the pandemic payments that companies are passing on input price increases to consumers and people are paying up. So as a result, profit margins for companies are near record highs. Now, of course, because they're so elevated, as you can see in the top chart, these margins may contract from these levels. So over the course of the year, there's a risk that these optimistic earnings estimates could come down a little bit, but for right now, they look pretty good. Also, another point to note, the market pullback has also improved valuations. And these improved valuations are giving investors confidence to buy the dips and are providing solid support to the markets. We've seen time and again over the past 2.5 months that every time there's a big dip, you're seeing buying coming in. And that's a very reassuring, a very encouraging sign. So putting it all together, we are staying the course with regard to our portfolio strategy. Last year, the pendulum of investor sentiment had swung towards extreme greed. You saw that in many facets of the market, SPACs, cryptocurrencies, meme stocks. But now, this pendulum has swung to the other side, to extreme fear. And we think this is good because it's what gives rise to buying opportunities. It's finally time for the TSX to shine. The index wasn't a favorite for global investors, for global fund managers for many years because of the socially responsible investment movement, the ESG movement, that took hold. And there were questions about Canadian oil sands, our commodity extraction process, and so on and so forth. Some of these sectors were being shunned by investors, but no longer. As the past 3 weeks have shown us, the world needs a stable supplier of energy and commodities like Canada. And as we see rising demand for Canadian energy and Canadian commodities, this will benefit the TSX, and by extension, it will benefit all of us Canadian investors. With regard to your portfolios, we've already rebalanced them twice this year, once in January to increase our allocation to energy and financials. And we again rebalanced last week to take advantage of the 10% dip in the S&P 500. I just want to reassure you, we are watching the markets and your portfolios very, very closely. I've been in the markets for more than 25 years, hence the gray hair. And over that time, I've seen 3 major recessions caused by the dot-com crash, the great financial crisis, and COVID in 2020. And in every instance, the market has rebounded after a period of time and gone on to new highs. One final point I'd like to make is that it's at times like these that investors need active management. And apart from the combined experience that all of us on the team have, we also have the fund managers who manage the Platinum and Steadfast funds. Now, these guys are really best of breed managers, and many of them are experts in growth stocks, which are going through a very turbulent phase right now. But there are some unbelievable bargains out there, and we are looking for these managers to snap up those bargains for us. So finally, times like these can test the resolve of any investor, but we are staying the course, and with your best interest at heart, we would strongly advise you to do the same. I'd be happy to take any questions. Thank you. Aaron?
Thank you, Elvis. It's a great, quick market update. So that's all we have for today. We'll bring John, and even Robert, you can come in and join us on the chat if there's any questions that you think we should address. But otherwise, or if people want to throw in some more questions, we can answer them here live. But otherwise, that's it for our our slides and scheduled remarks. And if we don't have any more questions, we'll let everyone kind of go. And we thank you for attending. We would like to continue to do more of these, not just on market updates, but other financial planning, tax planning, CPP, kind of whenever we have a lot of similar questions during certain times, we want to provide one of these webinars so that we can answer those questions broadly to 100 people all at once and give all that information. So we always take your feedback, and if there's any topics that you wish us to talk on, let us know. And we just want to thank you for taking the time. There will be a replay available that'll go out to everybody so they can access this. And tax time, I told you where to get everything and how to do it, but we're here to help too. If you need anything, we're here to help.